Are you aware of where your hard-earned money is going when you invest in mutual funds? A deceivingly simple question, isn't it? But the truth behind it is far more complex and, dare we say, provocative. This is Investor Wise, and thanks for joining us as we simplify a complex financial world into smarter choices for you. So when you entrust your wealth to mutual funds, you're stepping into a vast, intricate world of finance, one that is often shrouded in jargon and complexity. And one name stands tall in this labyrinth: American funds, a division of the Capital Group. Known for their extensive portfolio of mutual funds and ETFs, they've been a go-to for investors worldwide. But what's the real story behind their shiny facade? How do their products truly stack up against the competition? And more importantly, are you as an investor getting the best bang for your buck? These are the questions we'll be daring to ask and answer today. The answer to this question is not as straightforward as you might think. American Funds, a division of the Capital Group, has a storied history in the world of mutual funds. Born from the financial landscapes of the early 20th century, this investment titan has carved out a distinct place for itself in the annals of Wall Street. Its legacy rests on a unique approach to investing, one that emphasizes active management over passive index tracking. The company's distribution strategy is primarily through financial advisors, a model that has allowed it to build trusted relationships with its clients and those that peddle its funds. This strategy has also created a distinct space for American funds in the marketplace, one that values personalized advice and guidance over self-directed investing. In terms of product offerings, American Funds provides a wide array of mutual funds, each tailored to meet a specific investment objective. These funds are often contrasted with exchange-traded funds, or ETFs, a newer investment vehicle that has risen in popularity due to its lower cost and increased flexibility. Unlike ETFs, however, mutual funds offer the expertise of professional portfolio managers who actively select and manage the fund's investments, like picking specific stocks. American Funds' commitment to active management is seen as a key differentiator in its product offerings. While ETFs typically track an index, American Funds' mutual funds are actively managed, meaning that they aim to outperform the market rather than simply match it. This strategy has led to some notable successes, with several of their funds outperforming their benchmarks over the long term. However, the performance of one of its most widely held mutual funds, the Growth Fund of America, has raised questions. With over 300 stocks in its portfolio, this fund has provided decent returns for its investors. Yet, when compared to the S&P 500 index, it falls short in terms of 5- and 10-year total returns. This underperformance, coupled with a higher expense ratio than similar ETFs, has led to a reconsideration of the fund's value, making this fund a cornerstone in the debate over the merits of active versus passive investing. The Growth Fund of America, despite holding over 300 stocks, has not met benchmark performance when compared to the S&P 500 index. Let's delve deeper into this. As one of the most widely held mutual funds, it has been providing decent returns for investors over the years. However, when we look at the 5-year and 10-year total returns, the fund falls short of the performance of the S&P 500 index. A key factor contributing to this underperformance is the fund's lack of concentration in the so-called Magnificent Seven stocks: Apple, Google, Microsoft, Meta, and Amazon. While some investors might view a concentrated portfolio as risky in the case of the Growth Fund of America, its more recent relative underperformance is tied to not holding enough of these powerhouse stocks that have been driving index performance. In the grand scheme of investing, if an active mutual fund is not meeting or surpassing its index benchmark, it's time for investors to reconsider their holdings. Take a moment to question whether it makes sense to hold onto a fund that is underperforming. Another complexity of this fund is its high cost. The Growth Fund of America charges a large front-end load of 5.75% upon initial investment. Furthermore, its ongoing expense ratio is much higher than typical S&P 500 index ETFs. These costs can eat into your returns over time, which is a crucial consideration for any investor. This fund is widely held by individual investors, many of whom were likely sold this option by an advisor. While advisors from companies like Edward Jones may not be intentionally misguiding their clients, many uneducated or beginner investors might not be aware of the high costs associated with mutual funds, or the potential for underperformance compared to index investing. In light of these factors, investors should question whether it makes sense to hold the fund. It's crucial to examine your investment choices, compare performance, cost and fund holdings, and consider alternatives that could potentially provide a better, more cost-effective result. The new year brings an opportune time to do just that. While the Growth Fund of America underperforms, low-cost index ETFs like SPY or VOO have been providing higher returns. Let's delve into why these exchange-traded funds or ETFs are gaining popularity. It's a tale of performance, cost, and simplicity. When we look at performance, we see that low-cost index ETFs consistently outpace many actively managed mutual funds. In fact, the S&P 500 index itself has outperformed the Growth Fund of America over 5- and 10-year periods. And it's not just about the numbers, it's about the strategy. ETFs like SPY and VOO are designed to mirror the performance of an index, such as the S&P 500. This passive strategy reduces the risk of human error, which can plague actively managed funds. Next, let's talk about cost. We've all heard the saying, "A penny saved is a penny earned." Well, in the world of investing, a basis point saved is a basis point earned. The expense ratios for these ETFs are significantly lower than those of many mutual funds. For instance, SPY and VOO have expense ratios as low as 0.09% and 0.03% respectively, while the Growth Fund of America carries a heftier expense ratio, near 0.5%, not to mention a substantial front-end load or cost paid by the investor up front. Simplicity is the final piece of the puzzle. With an ETF, you're buying a slice of the entire index. There's no need to worry about the fund manager's decisions or the concentration of certain stocks. You're essentially buying the whole market. And isn't there something quite appealing about that? To top it all off, companies like Vanguard have made it easier than ever for self-directed investors to buy these ETFs. It's a trend that's empowering individuals to take control of their financial futures. So, while the Growth Fund of America may have once offered value, today's savvy investors are turning to low-cost index ETFs. They're outperforming, they're cost-effective, and they're simple. The new year brings an opportune time to examine your investment choices. And as we move forward, remember this. The goal of investing isn't just to make money, it's to keep it. If you've made it this far, give us a like and subscribe to support our work. We really appreciate it. It's high time for all individual investors to reconsider their holdings, especially mutual funds. As we step into a new year, it's time to take a good, hard look at your investments. It's time to question, to probe, to dissect every aspect of your portfolio. Are you getting the returns you were promised? Are the fees you're paying justified? Or are you simply lining the pockets of investment managers with your hard-earned money? There's a sense of urgency here, a bias to take action and take control of your hard-earned money. It's not about making hasty decisions, but about making informed ones. It's about understanding that the landscape of investing has changed. It's no longer just about mutual funds and their promise of diversification. The world of investing has evolved, and it's time for you to evolve with it. Take a moment to compare your current holdings to readily available alternatives. There's a whole universe of cost-conscious investment strategies out there. Companies like Vanguard are leading the charge, or see our other video on Wisdom Tree Prime. These offerings and strategies that maximize your returns while minimizing your costs are key. It's about keeping more of your money in your pocket, not in the coffers of investment managers who may have simply sold you something that was okay, but it's time for better or best. Think about it. Why pay a hefty fee for a mutual fund that doesn't outperform its benchmark index? Why invest in a fund that's less concentrated in core stocks that have driven index performance? It's time to question the status quo. It's time to make your money work harder for you. It's also not about fear, but about empowerment. It's about taking control of your financial future, about making smart choices that benefit you in the long run. It's about learning, about growing, about becoming a more aware and self-directed investor. So, as we step into a new year, take this opportunity to review your investments. Look at the performance, the cost, the holdings, compare, question, learn, and then make a decision. A decision that's informed, that's smart, that's beneficial for you. The world of investing is ever-changing. Don't let your investments stagnate. As we've traversed the landscape of mutual funds and ETFs, one thing becomes resoundingly clear. It's time to scrutinize your investment choices. Remember, the Growth Fund of America, while historically robust, has underperformed when compared to the S&P 500 index over the past critical 5 years. This underperformance is tied to its lack of concentration in key stocks that have driven index performance. There's the options of low-cost index ETFs like SPY or VOO, offering a more cost-effective and higher-performing option. This is a fact that competitors like Vanguard have already recognized, and their self-directed investors are reaping the benefits. So, it's time for you to reconsider your holdings, review your mutual funds, their performance, their cost, and their holdings. Compare them to the readily available alternatives. It's your hard-earned money after all. Take action now. It's urgent for you and your future. You can do it, and we're here to help. So join us in our mission to be investor wise.